Welcome to Striking Options. This show reveals the options you have to better navigate markets. I'm Jeff Kilberg, and I'm joined today by Bob Icino. Welcome, Bob.
Thanks for having me, Jeff.
Well, really interesting. Earnings season is upon us. We saw 44 names in the S&P 500 report last week. We really had a big kickoff by JP Morgan. We also saw Morgan Stanley. The financials really set a pretty optimistic tone last week. But this week, we have 58 different S&P 500 companies reporting. Will we see that optimistic tone persist?
I think so. I mean, people have to look at earnings is obviously going to drive it. But if you go back to 1945, sometimes people get scared because the market was up 28%. They think it needs to fall like it's due. But if you go back to 1945, every single year after a gain of 28% or more has been positive, except for 1945.
Well, that's pretty interesting. If you look at the year 2019, yes, we did have a 30% move higher in the S&P 500, but you can contribute a lot of that, at least 10% of it, to that snapback of that oversold condition we saw in December of 2018, correct?
Yeah, almost that entire last quarter was the downside for the year, down 9.5% over that last quarter.
Well, a lot of statistics to chew on here. We are excited about earnings season, and this is so much fun to see all these different reports coming into the marketplace. More importantly, to talk about what 2020 and 2021 may have in hold. But are you ready for this first lightning round, pal?
I am ready.
Crude oil. Well, it's interesting to see crude oil. We had a lot of emotion in the crude oil market to start 2020. Now it's subsided back under $60. Is this trade range bound?
Well, it's been in a range for basically the end of 2019 was a range, and all it seemed like we did was extend that range to a high of about 63.50. So looking at a trade example, I think I want to look at selling a call spread in crude oil. So selling the 61 call and buying that 63 call in case we break out to the upside, collecting about $140.
This makes a lot of sense. It expired January 31st, next Friday. When the March futures was the underlying futures contract, trading around 58.52, and that at the money volatility was about 25.64. This trade example is really interesting, Bob, because it does line up with this trading range. I know a lot of people got emotional. We saw it at $63, $64, and we talked about supply coming back in, but what is really going to move us out of this range?
Well, again, it's been a demand story. So we've got trade deals starting to happen. If that affects actual demand, not potential demand, you could get that breakup.
All right, great stuff. And please remember, these are trade examples, not trade recommendations. Let's move in the second lightning round, pal.
Let's do it.
New all-time highs. Well, sure enough, January 2020, after a robust year, a nearly 30% gain in the S&P 500 for 2019, we have seen just a phenomenal start. So here we are with new all-time highs. What say you?
Well, again, earnings have started out very good, especially the financials. We're getting into some of the tech stocks in a little while, so those look positive as well. So we're getting those new highs as you would expect.
I talked to a lot of active investors, and certainly there's a little bit of concern after that big up year in 2019. So the trade example I want to talk about today is a risk reversal. So if you have a long equity exposure, U.S. equities, tech, pick your beta, understand your beta. But the risk reversal I want to present is selling a risk reversal, Bob. I want to highlight the 33.50 strike. That's the upper end, only about 1% out of the money, but I want to be a seller of the 33.50 call, and I want to buy the 32.50 put in the E-mini S&P 500. Tell me a little bit about how this risk reversal and how we finance buying that put.
Well, again, when you're selling the call, and this one is not that far out of the money, you're getting a lot of credit from selling that call, and you're protecting that portfolio. That's really what you're trying to do here. It isn't necessarily a speculative trade.
And yes, typically a risk reversal we'll utilize as like a zero cost. Whatever we can sell that call, we'll buy that equal put, so there's zero cost. But here, I want to collect some premium. The March futures are the underlying trading around 33.20. The at-the-money volatility is about 10.76. So this spread, a typical zero-cost spread, is actually a credit spread. I'm going to collect about $137.50, Bob.
And again, you could theoretically go higher on the call side, lower that credit, again, since this is more likely to be hedging a long portfolio in equities.
And one more thing to think about in the event you're still getting comfortable in trading options on futures. At that 33.50 level, that's a level I identified to be a little bit short-term resistance. Maybe utilize the micro E-mini S&P 500. You can start feathering in a position there, and if you were to sell 10 of those micro E-minis, that would essentially mitigate about $150,000 of U.S. equity exposure to the S&P 500.
Yeah, and also the at-the-money volatility is about 10.76. That's pretty low. It's another reason why it's a good thing to look at this kind of an example.
All right, Bob. Well, thanks as always. We want to thank you for tuning in to Striking Options. Please tune in every week as we will continue to strike options.